My name is Jesus Hurtado, and I'm gonna talk about the cost of capital of AT&T. In order to calculate the WACC of AT&T, we need to know what percentage of the company is financed by equity and what percentage is financed by debt. The percentage of equity it's at 54%, and debt it's at 46%. The cost of equity it's 8.61, and the cost of debt it will be 3.62. The annual effective rate of tax rate of AT&T it's 1978, which gives us a WACC of 6%. We're gonna talk about the short-term debt of 2017. The short-term debt is obligations the company needs to pay in 1 year or less. The obligations they had in this year it was 38 billion, and the cost of this short debt it was 4.40%. AT&T is almost equally funded by equity and debt. They have an equity percent of 54, long-term debt of 43%, and a short-term debt of 2.67%. These numbers give a confidence to the investors since they know most of the company was funded by equity, which reduces the risk of owning the stock. I'm going to talk about the debt to total capital ratio, which is 44%, and this is calculated by dividing the total debt by the total debt plus the equity. Another important ratio is the common equity to capital ratio. This is found by dividing the total fixed assets by the equity. The fixed assets AT&T has is 139 billion, and the equity will be 207 billion. The result from this calculation is 0.67%, which any number below 1, it's a good sign of the company because it tells the investor that this company can fund most of its assets by raising equity instead of acquiring more debt and making the stock more risky. Analyze what would happen if AT&T would decide to add more debt to its capital structure. The 10-year US Treasury bond is at 2.67%, and a premium a bank will demand it's a 1.5. The before tax rate is calculated by just adding these two numbers together, which it will be 1.17%. As we all know, using debt can have some tax benefits for the company, reducing the cost of the debt. The short-term debt, after using the effective tax rate of 1978, can be reduced from a 4.40 to 3.53, and a long-term debt from 4.17 to 3.35%. Here we can see how just using debt to finance projects can have a really beneficial and way to add value to the company. Last thing I want to talk about is the security market line. This line represents a visual representation of the CAPM, and you can see how a higher beta will give you a high return. AT&T has a beta of 0.81. A risk-free rate we're using is at 2.67, and the risk premium is 7%. When we run the CAPM, we see that AT&T can give us, or we can expect, an 8.34% return in our investment, which is lower than the general market.